Welcome to the Not Your Average Investor Show Tuesday edition. Today we are sitting down with Ed Cernobori, who will teach you how he went from being a financial analyst to believing in real estate as the number one wealth creator. What are the best markets that he has invested in and why? And what are the best property management practices across all the different markets in the US that has him as a believer and as a customer of that service? That's where we are. You call it an online meeting. I call it, we are live on Facebook for the Tuesday edition of the Not Your Average Investor Show. I am your host, Pablo Gonzalez. With me, as always, the man that we call GC, because he's got genius concepts, because he knows how to generate cash flows, and because he's a great co-host. Coincidentally, also, his initials are Greg Cohen. Say hello, Greg.
Hello, everybody.
And today, the star of the show is a man who is a reformed stock market analyst, no, not a stock market analyst, a financial analyst, a financial portfolio investor who saw the light in the real estate industry and has since then grown a wide, diversified portfolio across multiple markets where he uses different companies to do his property management. And he is going to shine a light on the value of your property manager and what to expect from them. Welcome, Ed Cernobori. Welcome, Ed.
Oh, thank you. Well, thank you. It's great to be here. Yeah, I'm happy to kind of sit down with you guys and kind of go over, some of my past experiences, and hopefully it can help anybody out.
We're excited to have you, Ed. And after all that care to find out about your last name, I sat there and I just transposed 2 syllables there, man. I just buckled under the pressure, man. My bad.
Ed's in the group. Ed's in the group. Pablo has a real knack for just butchering last names. So, now you're a real member of the show.
All right, time to test that theory, because we have a little tradition here that we call the Not Your Average Investor Family Roll Call. You guys ready? All right, game on. John Hannon, good afternoon, all. Leo from California, good morning with your trademark California. Nadeem Shah coming at us from the West Coast. Hey, y'all, good morning, good afternoon. Drew Barnhill from Atlanta, good afternoon to you, Drew. Zach Correa, the famous Zach Correa. Aloha, all right, Zach, you're making it real hard for me on the Hawaiian. Raul Tirado, I can pronounce that name, no problem. Greg, in your face. Hi, everyone. Lee Bishop, the reigning MVP of the Not Your Average Investor Show family. Lee, welcome. Who else we got? We got anybody else? All right, that is, Jen Filson coming in. Hey, JWB family, what's up? Good to have you in here, Jen. And it's good to have the Not Your Average Investor Show family in the house. As you know, if you are looking to know about how to own and invest in rental income properties, you're in the right place. If you are looking to, particularly today, find out about best practices for property management and how important that is for your rental journey, you're in the right place. And if you're a real estate professional that is looking for an edge in the Jacksonville real estate market and a couple of additional opportunities for you and your clientele, you're in the right place. Next step is you go to chatwithjwb.com, hop on a call with our team. We will walk you through whatever else you need to know about, get to know you, find out your priorities, and see if it's a good fit, give you a bunch of great advice. And today we got somebody else that's given us some great advice. It's Ed, who has been you said you've been a client for 4 or 5 years?
Yeah, so I started out, it was a few years ago when I was actually looking to help my parents transition out from the stock market and really to diversify into real estate. And so I really started with turnkey providers. And I live in California, in San Francisco Bay Area. And it was, for me, it's very simple, because for me, looking at a map, it's just, you look to see where the best areas for growth are, where the best areas for income are. And so really what was trying to do was really trying to transition my family's assets from the stock market, which I was a financial advisor for 15 years, I think. So I'm really transferring all those assets into hard assets, into tangible assets, because we saw, had really a good idea that inflation was going to happen. So, who knew it was going to happen to this extent? But, we get to talk about that later. But yeah, so I basically got into real estate, looked at what turnkey providers were available, what the different areas were. And so, yeah, just visited a lot of different cities to kind of find out where the best fit was for my parents. So yeah, I basically went out, met with Greg and his whole team out there, and we started to invest with them we started with one house right away.
I remember those conversations, and the thing that stood out to me so much was I felt like we both connected really well about what the opportunities were in real estate. And then it might have been our second or our third phone call. And I said, just let me know a little bit more about your background and your career and what got you here. And you said, well, something along the lines of, I'm a financial advisor. And I was like, wait a second, that's not what I was expecting. You guys don't even think about hard assets like rental properties. And I was like, bring me up to speed here, because you are like that mythical creature of understanding really about, I would say, having such a high level of expertise in the traditional assets, and you fell in love with the non-traditional assets. So from a financial advisor, former financial advisor, could you share with everybody what your thought process was that made you, in essence, change your career path and definitely your investment strategy and the investment strategy of your parents to go to something like rental properties? What was that transition like? What led you down that?
So it actually started with a friend of mine emailing me a link to buy a property online. He said, I think he said it like as a joke. He said, "Do you believe people can buy properties online now?" And it was a link to some rental management company that I don't even remember what they were. Really? But I saw that this was 2015, and the link, and I clicked on the link, and then I actually bought my first house online, which was kind of how it happened. And I bought the house for $77,000 in Houston, Texas. And being from the Bay Area, it's like there's nothing that's available for, even at the time, 2015, like you can buy anything for less than 1.5, $1 million or whatever it was. So to me, it was like, I had always been interested in real estate, but it's living in the Bay Area was just so difficult to kind of bridge that gap. So that's really kind of that's one of the things that really kind of opened my eyes to it, to make sure that it actually was available. So that's one of the things that kind of blew me away. So
what are the things that you love about rental properties that you couldn't find in the traditional assets? Because I'm assuming it would have been much easier for you to stay in your career path and where I'm sure your money was invested before, but you must have seen a huge opportunity in rental properties. So what did you love so much about rental properties that made you make a change?
So it wasn't, I always liked the idea of it, but even from like the Carlton Sheets day from way back when, but being the Bear, you just can't do it. So I had always been interested in basically helping people with finances. So but you couldn't do it in real estate. So I just went to the stock market and just went the traditional route. It wasn't really until I had that actual, until it became real, until I actually had it, because its theory is one thing, but reality is another. So it's like I couldn't bridge that gap until I was actually in it and actually seeing those returns. So it's one of those things where it's like, yeah, it's okay. But actually doing it and seeing the returns, I remember it was like 2016, and at that point I had a few properties, because you kind of get like little bug or whatever. But I remember the stock market was having a banner year at like 20% or whatever it was. But my little 4 properties that I had bought like kind of all over the place was significantly better than that. And it's like, this was all turnkey, literally buying online. And it's like, and how can the returns be so much better from real estate than having this banner year in the stock market? And then I started listening to all the different kinds of podcasts. And then I think it was like Keith Weinhold, the real estate guys, and then started like just delving in. And that's really when everything really blossomed as far as like opening up, because I started looking at the economy a completely different way. I've always just looked at it through the traditional lens, and without having, number one is just the doing of it is kind of what sparked it. But then you realize, then you go down all these little different rabbit holes of like why real estate is better, and then physically, like literally comparing one to the other and like seeing it firsthand makes all the difference.
Ed, do you have any anecdotes of exactly what you were comparing one to the other? Like, were there things that really stood out for you more so than anything else of what you were doing?
The thing that about real estate was really the different ways of how it appreciates and how you get value from it. So it's not just the income, it's not just the appreciation, it's a combination of everything. It's a combination of the tax benefits, the inflation protection, it's the leverage that you use. I was literally buying houses for, in the hundreds, like $100,000 house, something like that, putting down 25%, and having it go from 100,000 to 110, 125, but you're not making 10 or 25% on your money. You're basically doubling your money. And that's just from the appreciation. That's not from the income. That's not from the asset protection part. That's not to mention the part that it's tangible. You can literally go in and fix them up. And this is before I actually just completely changed careers and started going in and fixing up the houses and basically enforcing equity. So that's like a whole nother way to do it. So it's became, so that's just one, and there are so many different ways, because like, I guess another way would be that it's something that's happening right now in front of you. It's not like you're investing in like Coca-Cola or something. It's like, do you even drink Coca-Cola type thing, where it's like, if you're benefiting a community directly. You're not just investing in having your energy, which is your wealth, being wherever. It's like you have a much more direct control impact on the world, which is something I really,
I mean, that's spot on. You picked on a couple of things there that really matter, right? And I know you've gone to a pretty high level now as far as your real estate investments, and I'm sure we'd all love to learn a little bit more about that. You're at the point now where you can actually make a change in neighborhoods, not just one house, right? And you're making a change in neighborhoods. We've been blessed to have that same experience, and you just don't get that by investing in paper in the stock market here. And the other thing that you mentioned, it's like, people in the stock market, when they would when they have a banner year, what they're qualifying that based on is appreciation of the stock, right? It's stock appreciation. It was this price and it went up this price. And if you had a 16% appreciation, stock appreciation year, you'd call that a banner year in the stock market. Right. And you don't have these other profit centers. You don't have tax savings. You don't have principal pay down, right? You don't have positive cash flow, right? It's not a hedge against inflation. If you translate that to what a banner year is in real estate, it's really no comparison, right? Because if you just have 4% appreciation, which is the historical norm for Jacksonville, and you use smart debt effectively, and you only put 25% down, that's 16% appreciation just in a normal year, which is what has been happening on average for the last 30 years in Jacksonville. And that's just one profit center in real estate. And then you've got the other four profit centers, which are, another 5 to 10% of returns as well. So it's like, it's just wonderful hearing this from somebody who came up through traditional assets. It's like, wow, this banner year in traditional assets in the stock market, well, I don't even count that in my returns many times on the real estate side. Yet people in the stock market say, oh, well, you only make $25 a month in cash flow or $50 a month in cash flow. There's just a real disconnect there.
Yeah, there really is. And I mean, it doesn't help that like every single marketing thing that's coming at you from like the mainstream media is promoting the stock market. When they talk about the market, it's not the real estate market they're talking about. It's always the stock market. And it's always, I mean, because, and like, granted, it's exciting type thing. You see it go up, see it go down, and it is wildly popular with the media, with news outlets, and that's just where you get constant reinforcement, where something that, if you think about a traditional investment, you would look at real estate, but you wouldn't consider, I mean, that's what investing was before the stock market. It's like, well, you have shares in a company. It's like, what does that even really mean?
Yeah,
or
right.
You can buy a house, fix it up, and like get cash flow. Like that's like, okay, which is more a traditional asset, right?
That's funny.
So,
Ed, Lee Bishop has a question in here. And by the way, this is a crowd-driven show, right? We're picking Ed's brain. We want the audience to participate. There's a couple ways to participate. One is in the chat, where there's already great commentary, like Leo talking about how expensive the Bay Area is versus other markets. Lee put in here in the Q&A, which is the best place to get your question answered on the show, is to pop open that Q&A and have me ask Ed and Greg a question. We also have friends joining us from Facebook. If you're in Facebook, give us an emoji, give us a housing emoji, or give us a thumbs up or something like that. And if you want to come on the show, you can. We'll send you the link right away. So we love the Facebook audience, and you're more than welcome to hop in on the call. All you got to do is comment, and we can send you the link to register, and you can put it in your daily routine. But Lee's got a question here for you, Ed. Ed, what assets did you have available to convert to buy rental houses? Was your IRA stock money tied to a job? So I guess he was asking, did you have IRA stock money to invest? Did you liquidate from the market? Did you use other assets? How did you get into real estate, coming from the background that you had?
Yeah, so I did it in a couple different ways. I mean, I had the assets, I mean, especially for the $77,000 house, I think it was like $20,000 or whatever it was. So I mean, I had that available to me that I had, through savings. So that I was able to buy. That's how I got started. I did make the error of it wasn't. It's technically an error, but it turned out great. I basically needed money to buy one of the houses and I didn't have enough. And so I literally just took it out of my IRA. And so while I took out $30,000 from an IRA, I basically knew I was paying $15,000 in taxes or whatever it was. But at the time, the deal seemed so good, it was worth it. And since it's been worth it, but now that I know better, there are other options available. So you don't have to take out $30,000 from your IRA and pay $15,000 in taxes. That's basically it's a rookie mistake, but there are ways to get above that. So learn from other people's mistakes. So don't do that. There are other ways to do that. So like opening up like a self-directed IRA or like an EQRP or whatever it is. So there are other ways to do that with retirements. I wouldn't recommend the way that I did it, but not coincidentally, but that actually worked out really well because the house that I did buy has doubled in value since, and it's been and that's the one of the houses I got in Atlanta, which introduced me to the property manager in Atlanta, which I basically bought a portfolio of homes with. So it worked out really well in the long term, but yeah, you just have to you have to go in there and just make mistakes sometimes, but that's how that went.
Yeah, and that's one of the beauties. I take it as that's like that only happens in real estate, right? Like you're buying the wrong way, but you have so many different ways to kind of like diversify the things that happen even within the deal itself, that you're able to take money out of one way the wrong way and put it in and it still works out, right? Like I don't know, I'm just shooting from the hip here because I'm not the expert, but I get the feeling that that's part of it. The other thing that you kind of alluded to here is you've already mentioned Houston, you've mentioned Atlanta, we know you invest in Jacksonville. Can you talk to us about the different markets and how you approached investing in different markets, what you like about each one, what is it about Jacksonville, that type of stuff?
Yeah. So when I took at it, I mean, for me, it was I looked at it from kind of like a blank slate where I looked at the country kind of on a map, seeing where are people moving to, because the biggest driver for appreciation and growth in my mind would be where people are moving to. It's a supply and demand issue. So if everybody's moving to an area, it takes a while to build houses. It takes a while to build inventory. And so real estate is much slower than the stock market, which you can see patterns develop. You can see things happening much easier than you can in the stock market. And so you can go in there and really just take advantage of it. So I went to different markets because of where the appreciation was. So I invested, I looked at like Dallas, Fort Worth was one of the areas that it's been one of the top growing areas in the country for like 10 years or something like that. But the thing is, the prices have appreciated a ton and you can't get the cash flow. So I bought in different areas to take advantage of different features, I guess. I mean, or benefits rather. So I basically started with my parents' portfolio because I was really looking at moving almost most things out of the stock market and into the real estate. So I bought in like Memphis, for example. I bought in Memphis for cash flow. I knew it wasn't going to appreciate as much as like a Dallas or whatever. I invested in Atlanta for both cash flow and appreciation. I invested in Jacksonville for appreciation and income. And it's one of the few places that are left even today that are still left, that you still have that little, it's like a simple price to rent ratio type thing where it's like you want to get like the old kind of rule of thumb or whatever you want to call it would be like the 1% rule, where it's like you want to get, if it's $100,000 house, you want to get about $1,000 in income. That now that we have all this inflation, it's that number skewed and it's very difficult to find. But Jacksonville is one of the few areas that hasn't done that yet. So, but to go back to your question, it's you buy in different areas for different things. So I bought in Dallas for growth, bought in Houston for growth, bought in Memphis for cash flow, bought in Jacksonville for both, basically. So you basically look around the areas, look around the country, and you can really, if you're objective, you can really look at different areas as far as where people are moving to and find what's important to you. So if If income is not important to you, then, then don't, and you want to speculate more, because if you're not getting cash flow, then you're speculating.
Mm-hmm.
So if you're willing to speculate more, then you can do that, but you don't have to do that with all your portfolio. You can do that with some. So it just depends on where you are and what fits your personal investment philosophy.
I think that's a really great way to look at it too. Again, I think it's cool to talk about this in terms of how people traditionally invest, right? When you're thinking about where to put your money in the stock market, or if they're in mutual funds, or if it's in your company 401k, you usually have choices, right? There's the aggressive growth fund, and then there's the balanced, strategic conservative portfolio, and some have, more equities and some have more bonds. You can kind of do the same thing with real estate markets, right? You've got, if you wanted to be super speculative, right, you wouldn't care about cash flow. You'd probably invest in California, right, where you see sometimes insanely high appreciation. Your cash flow is negative every single month. So that's a riskier portfolio. And then you've got, your markets, which are really cash flow heavy, even heavier than Jacksonville, right? Usually those are in the Midwest. You can get some really great cash flows there. Maybe those are your conservative and your bond heavy portfolio. And then you've got markets where you can actually get both, like Jacksonville or Atlanta, like it's talking about. So it's really cool to see it through both lenses there. You can accomplish very similar things according to what's important for you in your investing strategy. And then I think some people have thought about going to different markets, but they really struggle to find the right property management company. And I know how you've understood that from the very beginning. Could you give people some insight into how you exactly decided to invest and what you were looking at to make sure that the property manager was up to your standard as well as the market?
Yeah, that's a great question. I mean, because the most important part that I've found through this entire process is that it really comes down to having a good property manager. Nothing happens without good property management. It is, and I've gone through the gamut at this point. I mean, talking about like that first house that I bought in Houston, I've literally had the same tenant the entire time, but I've gone through 4 different property managers in Houston, which
Wow.
And it's not something you want to do. So, it's just because not everybody is the same. Not everybody gives you response time. So everybody's different. So, but you kind of have to kiss a lot of, kiss a lot of frogs, I guess would be the right, I don't know if it's the right term or not, but you have to just go through it. The biggest shortcut to avoiding kissing a lot of frogs is going to where people where you basically go through referrals. I mean, referrals and kind of and reputation are a big deal. So you have to have, it's kind of like going back to using other people's mistakes. People have a reputation, and really kind of just finding the right team that works with you is really important. So I can't emphasize that more, but that's literally the most important thing out of this entire process. So it's the housing literally is kind of the last piece.
So let's take that frog that you kissed in Houston, where the property management company is turned over 4 times. What's a lesson that you learned, maybe you put into play later on when you found other companies like JWB that you've enjoyed working with? What's something that you could teach others to do differently if you could change it again with that Houston property?
I mean, with the Houston property, one of the things is that I wish I would have done more, and it would have saved me more headache, is to literally fly and go meet them, like meet the team in person. If you can do that, I mean, that's not always feasible. I mean, I know, but it's especially if you're trying to buy a lot in different areas. But that's like the number one thing, that if you can do that, then absolutely do that. If you can't, then some of the things that you want to do is basically see if you can get like some kind of reporting from them, like if they have any idea of what their numbers are as far as turnover. And you want to look over the expenses, but I mean the expenses, the expenses is pretty secondary. It's really kind of how they position things and what it's like you just kind of, it's like interviewing like anybody. It's like you have to just interview them. You have to talk with a property manager. And if you're not used to doing it, it takes a little bit of practice. I would say that having like a schedule of what you want to get done, like if you want, you should absolutely have your properties. And so if you don't have like an inspection schedule or something to that effect, then that's something that's really important to have. And if they can't provide, that was the biggest hang up in Houston, is I still don't have I've had a few inspections, but there's still work that needs to be done. There's nothing that, it's just, it's a disaster still. So I'm looking at probably selling that house I've never sold anything, so it's going to be a whole nother process, but I'm literally selling it because of management. And it's like, and there's no other reason. Well, it doesn't matter. But so number one, get inspections done. Number two, interview everybody. Actually, and if you can just develop a relationship with them would be the ideal. And try to do phone calls as much as you can rather than just emails, because emails can get back. That's how I would do it. So just try to build a relationship with them and kind of see how.
I think it's sage advice. And I know there's a lot of folks that are in the chat right now, and I see the chat lighting up, that have purchased in multiple areas across the country. So if you guys have some ideas on things that you've done well to support others who might be thinking about doing the same thing, fire those in the chat. And for our friends on Facebook as well, this is meant to learn from the group. So really sage advice there for sure. For us, when it comes to property management, I guess we live in a bubble here where, communication for JWB is so critical. But what I find for outside property management companies, it's certainly not that way. When you talk to other property management companies, many times they don't feel like it's their responsibility to give you a phone call routinely. Many times they don't even feel like it's their responsibility to give you a phone call when something is going wrong. They expect you just to see it maybe in the reporting that they offer, or maybe they don't really offer reporting, or maybe it's not very in depth. So definitely make sure that the communication standards, are understood and they're up to your standard, because it's an industry that for many years was just mom and pops. It was just folks, and I say this sort of joking, but that accidentally got into becoming a property management company. Many times they were real estate agents that wanted some more of a consistent income stream, and they got into property management. That's not the same experience you're going to find if your standards are really high and you want to make this a big part of your overall financial portfolio. You want to have somebody who has a higher standard of communication. I think that's at the core edge is probably the biggest differentiator, I would imagine, through other property management companies. Would you?
Yeah. And just to kind of piggyback on what you're saying, I mean, one of the things that I've kind of developed is kind of like just a call schedule on my schedule to like go out and be in touch with the property manager. So just make it part of your routine, like part of like once a month, make sure that that you can look over the reporting. And if you don't understand the reporting, then call whoever the representative is over there that you have and kind of have them go through it with you. And you'll find out very quickly like how things like come to light, how some things don't come to light, and how the communication is, because you end up chasing the property manager, and that's not what you want. What you want is kind of a good relationship, but it's much more difficult than you would imagine it to be if you've never done it before. So it's something that seems obvious, but it just doesn't work out that way in real life.
Ed, I think when JWB put our standards in place for our communication, our customer service, we had Ed Cernobori in mind because, right, that type of a monthly phone call is so critical, right? It can be somewhat transactional in nature, but it can also turn very strategic, right? And again, if this is something that's going to be a big part of your portfolio, it's almost less of a property management phone call and more of an asset management type of a conversation that you need to be having with your quote unquote property manager.
Yeah. And Ed, I know that you have invested in a couple of different ways. I know that you've gone the turnkey route. I know that you've gone a couple of other routes, which we're going to get into in a second, but we have a question here in the Q&A from a listener from France. Name is Anonymous Attendé. And they ask, did you buy before having property management in place, or do you put, what do you get first, the property, or do you have the management in place before you get the property?
So I can tell you the wrong way to do it is to basically buy the property first and then get the property management. I've done that. So don't do that if you can help it. The best way to do it is to basically, after you've identified the area, is to, in an ideal perfect world, you would find the area after doing research, be comfortable with the location, and then finding the property management. And then you do that through interviewing different property management. And then after that, even if you're buying the house on your own and fixing it up on your own and then handing it over, and it doesn't have to be turnkey, that's kind of, those are like the three basic steps. So, but you can also, because the property manager will help, they can even help you find properties if they don't have them themselves, or like obviously through JWB, they literally have inventory that you can buy from them. So you can you'll have more options with somebody that has somebody that's more seasoned and has that capability.
And Ed, going on that stream of you having invested a couple of different ways, right? Like you bought some from JWB, and then you have other properties that you've bought in Jacksonville through you want to kind of talk about how you've acquired the rest of your properties in Jacksonville as well, and then we can talk about kind of how you position the property management there.
Sure. So we literally started buying turnkey from JWB because I knew the area was good. And then I basically did this one the right way. So we basically looked at the area first and looked at the property manager, talked with Greg, and then we basically kind of decided, okay, let's invest. And then the first one we bought from Greg was actually one that was in his inventory, in the inventory already. I think he had had the property for like 6 or 7 years or whatever it was. Mm-hmm. And so we knew it was a good performing property. The numbers looked good, so everything was fine. So we started with that. Worked out really well, had great, a really great experience with them. So we decided to buy a new construction from him. And then so we bought new construction. And then after the new construction, that's when I was visiting the area. And then I basically kind of really went in and bought a house and developed, like I was networking with a different team we basically started with like a team of a real estate agent that I work with and work really close with now. And we basically bought houses, and we basically bought it, did everything from the paint, the roof, everything, redid the bathroom, and basically built that up. And then after that, we basically just handed it to JWB to manage it. And that worked out really well too. So but it depends on how much effort you want to put into everything. And so if you're just getting started, and I mean, literally, Jacksonville is as far away from the Bay Area as possible. I think it's literally on the other side of the coast. So it depends on how much work you want to do. But it's one of those things where you have to give up something sometimes, where I think the three things are, it's like time, quality, or expense. And so it's like, so one of those three things, you can't always have those three things. And so the one thing you really don't want to sacrifice on is quality. So you want to have quality first. And if you have to pay a little bit more for whatever, because you will do better technically if you go in and buy the house and force equity and then basically turn it over for management. I mean, you're going to do better that way, but it's like, how much are you willing to do for that? And it's like, so it depends. And if you like it or not, because that comes with a whole different set of headaches.
Well, it does. I think it's great that you're shining a light on the fact that you can do this strategy a little bit different than JWB's turnkey model and still have success. There are going to be pros, there's going to be some cons to it, and neither is right or wrong. It's just better for your goals. And the really cool thing is that we can work with you no matter what your strategy is. I think really, especially on our show here, we talk a lot about the turnkey investing experience. And so it's so great having you as a client here to talk about how we've been able to work together in two different realms, right? You made the decision to invest with us in turnkey. It's wonderful that has worked out so well. And what's even better is that it encouraged you, it sounds like, to go even more into an active role of the Jacksonville market and in real estate and investing in a relationship that you also can trust with a real estate agent and with contractors and all the necessary work that goes along with that. The cool thing is JWB can still be your property management partner. So if there are folks that are watching the show and you may have been thinking, well, I'd love to buy turnkey properties, but right now it's not the right time, but I have 3 rental properties and I want to work with JWB. Well, you can be just like Ed. We manage those properties for the exact same fees and we do the exact same long-term leases, even if you don't buy the property with us. And I don't feel like we've shone enough light on that in the past. So thank you for bringing that up. And it sounds like, Ed, I'm not sure about this, but it sounds like when you went a little bit stronger, I guess in the Jacksonville market, did you also, I don't know, did you also try out a different property management company in Jacksonville?
Yeah, so I tried a couple different ones, and we actually did one where we self-managed one, which was a disaster. So especially, that one. That was the first house that we bought, and it literally took about over a year to kind of get through the headaches from that. So it's another mistake to avoid, is never manage yourself. It was a disaster. So
to explore some of the differences between, because what I'm understanding is you're bringing some of those properties that were managed by others in Jacksonville, and you're bringing those over to our management. I think we're up to 11 properties now that we manage for you, and I think you've purchased 2 of those. So I think it's 9 or 11 or something that you brought over.
So
Yeah, I would love for you to point out some pros and cons between JWB. Obviously, you're bringing them over to JWB, so I know you like us better. But talk a little bit about some of the differences that you've learned along the way, even with two property managers in the same market.
Yeah, absolutely. So because you guys have always had like my parents' houses in your portfolio, and so that's kind of how we developed the relationship. And then after that, I basically started getting into building a portfolio. So I basically did it with investors, so as a syndication. So I basically went out, got basically capital, went in and basically just went in and to buy, rehab, and fix up properties. Some of the houses that we bought had tenants inside with property management inside already. Mm-hmm. So we got a chance to kind of see and test out. I'm like, well, like since we're there, it's like, I don't want to have like, because, at the same point, while I did my research and everything, it's like, well, since we're doing it already, we might as well we'll try a few different things. So we did keep on a couple of different companies that already had management. I think we went through 4 different ones to kind of see, and then we self-managed, which was, like I said, don't ever do that.
That was your favorite thing to do all the time.
Yeah, no kidding. But some of the differences were pretty apparent pretty quickly, because like you realize it's on certain managers have, some management companies have a team that's like dedicated, and that's good. And so they're similar and similar type of model to yours, where you have, it's not just like a one-man operation or whatever it is, but it's like the response time is just different. So, but some of the bigger differences is you don't really know what the difference is until you can kind of experience it firsthand. So, but most companies won't do long-term leases. They don't do client communication well. They give you statements, and it's like, and when they get back to you, and it's like, it's just not, it's just in a level of professionalism just isn't there. And so it's very easy to see why people get so turned off from real estate, because that's how, unfortunately, I think that's how most people operate, is with bad property management. So it just becomes a headache that you want to avoid the whole time, because your property manager is the key, it's basically the link to your investment. And so without the cash flow, like, you don't know what's going on. Without like an irregular type of inspection or something, you have no idea if the water heater is going to just blow up on you or whatever. And so there are a lot of things that you don't want to deal with. Like, you have to make sure that the roof is good. So anyway, the point is, without doing that, I wouldn't know how good, what a good organization is compared to a bad organization. And some of the things some of the things to kind of focus on is really that constant communication with property management. It's very similar to like having when you're working with a financial advisor, you want to have like a monthly conversation or quarterly call or something. And without that, like, you don't, granted, you can see your numbers on the screen if you're investing in stocks, but in real estate, like, you have a house out there somewhere. So there's a big difference between having like something in front of you and not. And then really your property manager is your link to that.
Helps you sleep better at night, peace of mind there, knowing not only is the rent coming in, but you're knowing why things are happening and how can we plan and be strategic to make sure that we continue to get better in coming quarters, and how are we going to plan strategically for the next round of properties we're going to purchase. Those are conversations you just don't typically have with a property management company. And I'd love to know what the future holds for you, Ed. Are you growing your team with your contractor base and with your real estate agent? Are you going to take this bigger and bigger and really ramp up the properties in Jacksonville?
Yeah, that is absolutely the team. So that's the plan. So because I basically went from being a financial advisor and then realizing, kind of after figuring out how the stock market works and how much better, and like kind of behind the scenes in the economy, especially after reading like books like The Creature from Jekyll Island, like Rich Dad Poor Dad, all those things, they really alter your perception. And then now that you can have see things from a higher angle, I just basically decided to start my own investment company and really just focus on real estate. And so the best market out of the entire country that I'm focusing on right now is Jacksonville, from all the research that I've done. So the plan is to continue to work in Jacksonville, basically continue to go in, fix up houses, really help better the community as much as we can, and put investor capital to work in a meaningful way. And so that's really where we're focused.
That's wonderful. That's exciting.
I love it, man. That sounds really, really cool. Ed, we got a bunch of really good questions here I want to get into. from what you're saying, though, it sounds like you've done some turnkey property investing, and now you yourself are executing on syndication, right? Like, what's the difference in the experience when you are investing in a syndication versus a turnkey property? Can you kind of describe that?
So when you're investing turnkey it's you're owning the property, right? So, and you're owning one, and it gets better when you have a little bit more scale, because if you're buying one property and you only have like one or two perhaps, then, well, that's great. Like, there are going to be months where you're not going to get any income from those. You're just not going to, and then let's say you have like repairs, then like, so let's say you collected, your $100 a month or $200 a month, and you have like a $2,500 expense, then all of your profit from income went out that year. And that's just kind of what you have to expect with real estate. One of the benefits of investing, if you can't basically go in and buy, ultimately the best technically, how do I put this? The best way to do it is to basically have your own properties. I mean, I really think that that's ultimately the best way to do it, but it is more labor intensive, but you also have more control. Investing in a syndication, you're buying a pool of properties. Like, for example, the pool of properties that I have with you guys, with JWV, is basically 16 single family houses. So you're getting a fractional share ownership of that. So you're basically investing in that, but you don't have any control of it as an investor. You're basically relying on management, which is me and my team, to basically go out and make sure that that we repaired everything properly and basically have as minimal expenses going forward, and we hold it for a period of 5 years. You do experience some of the tax benefits, but not all of the tax benefits as far as like owning, if you were to own individually. So there are the benefits of investing in a syndication is that you don't have to do any of the work. You basically rely on other people who've gone through the brain damage to get there before you. Ultimately, I think everybody would be better off if they invested more on their own, but it's just not feasible for everybody. And so why make it feasible for everybody? So it's definitely an option. And so whether it's an apartment building syndication or a single family home syndication or a development syndication, there are all these different things that you can invest in, similarly to the stock market, where you're just investing and you're giving your money to a manager, and they are managing it for you. The difference in real estate is it's a tangible investment, and you know where your money is going, rather than a mutual fund where you have no clue where that money is going. And anyway, so that's even if you're investing in a company, you really don't know where that money is going. So it gives you direct access to the influence for your capital.
Yeah, I agree. I'll throw in just a couple other things just to add to the differences there. At the end of the day, I agree with you though, Ed. If you can own a tangible asset, that many times for you is going to lead to the greatest long-term wealth and control for you. Mm-hmm. However, it's not going to be perfect, right? So there's certainly a place for syndications. One of the things that's a little bit different though, and usually syndications are only available to accredited investors as well. So an accredited investor meets a certain income or assets threshold. So it might not be available to those who don't meet those thresholds. Whereas buying a single family house, you do not have to be an accredited investor to do that. So that's an advantage to being able to get into assets. But the diversification thing I think is real as well, right? The diversification of cash flows and assets is a thing that syndications really have going for them. You can accomplish that in rental property investing as well, but typically it's going to be, it's probably going to be accomplished over a number of years, which is great. You can start with one, but just know that if you're starting with one, the plan, and we help clients build this plan, the plan should get to 3 or 4 over a number of years. And we'd certainly work on that for you. But I think at the main point is, if you're only buying one asset, turnkey rental property investing is probably not right for you. Right? You can buy one today and have a plan to get your second one in 3 years, which is a great plan. But if your plan is to buy one today and then be done, maybe something different might be better for you, just because one asset's not going to be consistent all the time.
Yeah, I would agree. I mean, if you're only going to buy one, it's going to come with its own, it just becomes its own because it becomes a project and it becomes a job. And if you're not investing to have a job, you're investing to have a return. You're investing to have either the cash flow or the appreciation. You want the asset to do something for you, but you don't want to have to manage it. And so while buying through turnkey would be, I mean, that's as close as you're going to get to it. It's just as close as you're going to get to investing in real estate by. So, I mean, even if, yeah, I mean, if you're only going to buy one, maybe not, but it does get addicting though. So it's once you see, if you're willing to experiment, then definitely look at it. So, because it's, again, it's just, it should become, I mean, it should become a part of everybody's portfolio. I mean, in my experience, from being a financial advisor for 15 years, there's literally, for the average investor, there is nothing that you can't do with the real estate that you can do with stocks. So it is better to be invested in real estate than stock market. It's like, there is no doubt about it. It's not even close. So if you had to pick one to focus on, then do real estate, don't do stocks. But stocks are easier. The thing is, they're there, especially now because of with the inflation and the money printing, then it becomes super easy, and everybody looks like a genius when the market is up, but you have no idea where that money is really going. So it's, so if you had to pick one and really become, and because everybody's going to be investing for the rest of their lives is the thing. So if you had to become good at one, then become good at
A great call, man. The longevity of it, right? Like the fact that yes, it might have a lower entry barrier to start investing in the stock market, but at the end of the day, we're out here for the long game, right? So like as soon as you start investing, you're going to find out more, and then you're going to find out more, and then you're going to find out more. So if you're going to start with something, might as well find out about real estate and start getting really, really good at that, where the first incremental step might be a much higher step up. But once you get rolling down that path, you're going to be all right. Like Ed Cernobori, right? All right, Ed, we got a bunch of great questions. You know what? I'm going to go kind of backwards order because it plays into it. But Leo has this question, and he asks, Ed, are you still working a full 9-to-5 job? It's amazing and inspiring to hear all your real estate properties that you have. So Leo's just kind of asking what you're doing these days with your time.
Yeah, so I actually went full time into real estate, and I actually have a syndication company now, because I couldn't be a financial advisor anymore after basically realizing how the economy works, and I mean, it may have been like a bit of a, maybe a little bit too far of an extreme of a thing to like say that the stock market is evil, and it's like, okay, but the other thing is, like, I couldn't consciously be a financial advisor knowing that real estate is available and does such a better job for investing for people. So it's like, you just can't do it. So my original plan was to just go get a job and just invest in real estate on my own. But then I figured out what a syndication was, and now it's easy for me to bring syndications to other people and kind of just help just spread the word about how much better it is for real estate than investing in the stock.
We're going to make you a quote card about that one, Ed. I couldn't consciously be a financial advisor after figuring out how much better real estate is for people. You're going to get a little marketing asset from courtesy of the Not Your Average Investor Show. Ed, you know what? We're going to get into more of these questions, but now that you're talking about your syndication company, you're talking about all this stuff with inflation. I know that you got somewhere that you have a bit about an educational piece about inflation. You kind of want to talk about that?
Sure. So just briefly. I mean, I did a newsletter I did an ebook actually. I wrote it a few years ago, so I don't actually know how relevant it is right now, but I mentioned to you that right before the show, and I was like, I wonder if I should probably have checked on it before I said that. But it is on my website, which is blacktreegroup.com, and you can download the free e-newsletter on inflation.
Blackstreet Group?
Blacktree. So yeah, Blacktree, which is my last name actually. So it's Cern means black and Bori means forest, or the tree. So blacktreegroup.com.
There you go. All right, I put that in the chat, blacktreegroup.com, if you want to get in contact with Ed. Let's keep rolling with some of these questions. I would love to hear in the chat or on Facebook if you've invested in turnkey or syndication, or what you've invested in. Just put it in one of the comments here in the Facebook or the chat right now. All right. Anonymous attendee asks, those places you invested, this was from a while ago, but those places you invested in were all fixer-uppers, then rent for cash flow. Have you done any flipping yet, or are you kind of fixing and holding always?
I've just either bought and hold or bought, fixed and held. I haven't sold anything yet, although Yeah, I think the first house I think I'm going to sell will be my first one that I bought, and the only reason I'm selling it is, or the main reason I'm selling is that I still can't find a good manager. So I'm just gonna, it's just, and now it's appreciated in equity, and the rent can't support it. So I need to basically transfer it out to capture the equity.
There you go. Are you gonna 1031 exchange that puppy, or what are you thinking?
I don't know yet. I mean, there's not that much of a there. I mean, it's under 250,000. So I don't think I need to do the 1031 exchange.
Okay. All right.
But I will be buying something else with it.
All right.
Great example. Well, I was just going to say, that's a classic example. People usually start by buying the property. They focus on the property decision first, then they focus on the market, and then they focus on the property manager last. And you've got a property where you've made money on the property, right? You've had a resident who's been in there for 4 years. The market has grown. So those two things are working, but you're still going to sell it. It's because the property management isn't up to your standard. It just goes to show why now you follow that rule, right? I find the property manager first, then I choose the market, and then I choose the property last. Very different than what most investors do out there.
Yeah. I mean, that's from experience. It's because you want to live your life as well. It's like investing is in everybody's life. You want to basically have this investment to do something for you. What you don't want to do is have another job to do, because people are stressed out enough as it is. People have their 9-to-5s or whatever they do. They don't want to do investing most people don't want to do investing for their jobs. But if you're buying a house, I think that's the scariest thing for people, I think, and for investing in real estate, and investing with good management solves.
Well said, Ed. And good reframe, GC. I almost missed that little golden nugget. Raul Tirado asks, what research tools are you using to identify investing opportunities?
So I would say that a few different ones. I mean, it's more so once you really start getting into it, after you kind of pick your market, it's more so the real estate agents and that you're working with. It becomes less so dependent on the tools and the relationships that you have. So it's really kind of just being time in the market rather than kind of like, so that's the main thing, is developing a relation. As far as like looking at different markets, like there's different data as far as where, I mean, there are different kind of like heat maps from all these different places, like whether it's like I haven't looked at it in a little while, but I used to use Atom.com, ATTOM. Atom was the one that I used. You can look at like U-Haul rental, like just where people are moving to. I mean, even if you just Google search, like where are people moving to, there are several different places. So you can spend a few different hours looking at it. So, but there's no, rather than focusing on tools on how to like get better, it's really focusing on relationships, because the relationships are going to be where you're going to have the most impact.
Yeah, I think if you're just starting out and you're trying to decide which markets to go in, there are tools like Ed is mentioning. In fact, I put an entire training together where I break down how you can actually choose which markets are going to positively cash flow for you and which markets have shown the longest average historical appreciation rates as well. And all of these tools are free. So you can use that data. You can go there. You can go to jwbwebclass.com. That's free. That training's there. It'll show you what to look at. All that stuff is free. But Ed, you're right. Once you decide on the market, then it's that relationship. If it's going to be something you're going to be active in, then you're going to need to have a real estate agent that you absolutely trust, as well as contractors that you can trust. If you're going the turnkey route, then you're going to have a relationship with like a JWB who's going to be those boots on the ground and take you from kind of that macro to micro of actually making the right decision on a property.
Yep. And I'm just linking here, jwbwebclass.com in the chat. And all right, we got a question from the Zach Correa. Aloha, Ed. As an investor, I sought higher yields and less volatility, along with greater control over my investments, and began to place more capital in private real estate, and the category has thrived. Still, I think it is worth examining whether private real estate has lived up to the hype and performed better than stocks and bonds from a historical perspective. Over time, from your perspective, did real estate generate better returns for you as an investor with lower risk? Mahalo, Z.
That's a great question. And it's hands down that real estate is better. I mean, one of the things that's really difficult to look at when you're looking at historical data is that it doesn't account for all of the things that we talked about. They're looking at investments from, let's say you're buying a $100,000 house. They're like, well, what's the appreciation on the $100,000 house? Like, as opposed to Well, you don't have $100,000 in that house. You have $25,000 of that house of your own capital. The rest is leverage. So they're not looking at that. So they're not looking at, so it's very deceiving if you're looking at stock market info as compared to real estate. The other thing that really doesn't live up to its hype is the actual statistics for stocks themselves. It doesn't account for, if you look at like the Dalbar study, I think that's DELBAR. That's one of the ones that I used to talk about, because even if people don't just buy the stock market, people aren't buying, like, now you can. 50 years ago, you couldn't buy the S&P 500, for example. There wasn't like any Dow Jones index. It's like you had to buy the stocks themselves. So it's very misleading. So you have to really, and it doesn't account for if you decide to sell or if you panic and sell, like what happens. You can't do that with real estate. Real estate is very illiquid market. You're basically kind of, a lot of people will hold when things go down if they can. So it's very misleading. So I would say that it's rather than, so it's focusing on what's practical rather than like what a historical study is telling you. And it depends on who's writing the study as well to kind of see because you have to look for agendas behind people as well. And if not agendas, then how much experience do they have? Because sometimes if it's too high level, then it doesn't show you what reality is.
Yeah, I think that's a great answer. And I just think that's such a great question, Zach. Thank you so much for that question. I know Zach is somebody that has invested a lot in real estate. He and his wife are clients at JWB. But, that type of a question is one that people have all the time. And so I love the question. And I just wanted to give my simple answer too. Very similar to what you said, Ed. If you are looking at the long-term returns on investment in the stock market, you're looking at somewhere between 7 to 9% historically is generally what the market produces. Now, when you invest in the stock market, typically you don't have leverage, right? So you're looking for 7 to 9% returns. And at the same time, you don't have income coming into you typically in the stock market, or if you do, it's very little. So you get 7 to 9%, you don't get monthly income coming in, just really simply. If you're looking at rental properties and you're buying with cash, so you're not taking any leverage, you're looking at 5%, maybe 6% returns just coming from the income coming in from you, right? And then on top of that, you would have appreciation, which might be 3-4% on top of that, depending on your market. So if you're only buying in cash, you have, call it roughly around the same return on investment overall in real estate as you do in the stock market, but your risks are reduced because you have $700,000, $800,000, $900,000 a month in rental income coming in from that asset that is owned in cash. So your risks are reduced if you just go with a cash purchase. And what Ed's talking about is you compare stock market investments, which historically have produced between a 7 to a 9% return on investment, to a real estate investment where you use smart debt. That's where your cash flows generally are a little bit positive, right? Call it about break even. So you don't have that cash flow coming in as much, but your return on investment goes much higher than 7 to 9%. It can be upwards of 20% because of what Ed's talking about, where you're able to use smart leverage, the asset goes up in value, and you only have a small amount of your money invested. So either way you look at it, if you want a higher return potential, real estate generally wins over the long haul. If you're looking at it, you want to reduce risk and still maintain the same returns, real estate still wins there because of the income coming in. And Zach, great question. I know you know most of those, or both of those points right there. So thank you so much for bringing that up.
Yeah, and just to tag on a couple quick things, it also doesn't have anything to do with fees aren't in those studies, neither are taxes. So those are two things that have a very big impact on that. Because if you're talking about, let's say it's a 1% management fee in the stock market, well, that 1%, if you're only expecting 7 to 9%, that's 20% of your total gain. So so you have to look at it from you have to keep going down and keep drilling down.
Very good point.
Great answer, fellas. Great question by Zach all the way around. Rami Kauda had a question about he's got a bunch of properties and he's got a limit on his number of properties he can add under his current umbrella policy. And he was wondering if there's any additional cost-effective insurance companies, carriers to get policies. I feel like, correct me if I'm wrong, Greg, that's a good chatwithjwb.com question. If you can set up a call with the team, they'll figure out who you're working with and they'll give you some good options. Ed, do you have any off the top of your head of great insurance policy people you work with?
No, that's still a work in progress. That's one of those things that, that doesn't end from a management standpoint. You keep having to work with good insurance people. So that's still, I'm still working on that myself.
Got it. And then last question, Roger Evans asked, how easy or difficult is it to manage your real estate business in Jacksonville when you live so far away, Ed?
Again, it comes down to the team, because there are certain properties that become a real big headache, and and it does keep you up at night. But if you have good management, there's no problem whatsoever. I mean, it comes down to management.
Awesome, man. Ed, I know we talked about blacktreegroup.com to download that inflation study that you have up there, the ebook, right? That you wrote a couple years ago. Do the work, Fred. Let them know if it's still good. If it's not, if it needs some stuff, but go check it out, right? Inflation is a big topic.
To feedback.
Yeah. Let's give Ed some feedback. What's the best way to contact you? If somebody wants to reach out to you after this, they're listening to the show in their ear, they just watched, what's the best way to get a hold of you, Ed?
Yeah, the blacktreegroup.com. That will have that'll have it has all my contact information. That Edward at blacktreegroup.com, and also has my phone number on there, so feel free to give me a ring.
All right, and we learned today, Cerno is black in Italian and Bori is tree, right? Cernobori. All right, I like it. Thanks for joining us, Ed. This was great. Thank you to the Not Your Average Investor Show family. We had close to 40 people on this call, for an hour on the middle of a Tuesday. It never goes without notice that you take time out of your busy day to hang out with us here, hang out with the family, connect with the community. If you like what you heard, you want some tailored advice to whatever you need, go to chatwithjwb.com to find out about property management practices, to find out about turnkey properties. If you're a real estate professional looking for some new opportunities, chatwithjwb.com is the place to go. Hopefully you join us on Thursdays where GC and I go over the JWB Rental Legal Property of the Week, where we go into the JWB inventory and we analyze the deal. You can ask a ton of questions. It's a real big educational call for anybody that's interested in what these deals look like. It's been a pleasure, Ed, getting to know you. GC, I will give you last words, my friend.
Yes, thank you all for being here on the show. This is another incredible show, Ed. It is so great to connect with you after so many years here. Equal parts, I'm impressed with how you started with going from traditional assets into rental property investing. But the more that I ask questions today, I just realized that, you're equal parts kind of pragmatic, right? You do your due diligence, but when you see an opportunity, you're not afraid to jump. Right? You're not afraid to take a leap. And I love seeing how that same process has iterated multiple times in the time that we've been able to serve you in your family. And I'm really excited about where you're going to take your fund, your syndication as well. And just, it's a really cool example of how we get to support you as your investing journey continues to grow in ways outside of just turnkey investing. So super happy to have you here, and we'll keep the seat warm for you for your return when you're owning Jacksonville here.
That sounds great. It's been a pleasure. It's been great thank you for having me. It's been awesome connecting with you guys.
All right, guys, we'll see you on the next one.
All right.
I think it's cool to talk about this in terms of how people traditionally invest, right? When you're thinking about where to put your money in the stock market, or if they're in mutual funds, or if it's in your company 401k, you usually have choices, right? There's the aggressive growth fund, and then there's the balanced, strategic conservative portfolio. And some have, more equities and some have more bonds. You can kind of do the same thing with real estate markets, right? You've got, if you wanted to be super speculative, right, you wouldn't care about cash flow. You'd probably invest in California, right? Where you see sometimes insanely high appreciation, your cash flow is negative every single month. So that's a riskier portfolio. And then you've got, your markets, which are really cash flow heavy, even heavier than Jacksonville, right? Usually those are in the Midwest. You can get some really great cash flows there. Maybe those are your conservative and your bond heavy portfolio. And then you've got markets where you can actually get both, like Jacksonville or Atlanta, like it's talking about. So it's really cool to see it through both lenses there. You can accomplish very similar things according to what's important for you in your investing strategy. And then I think some people have thought about going to different markets, but they really struggle to find the right property management company. And I know how you've understood that from the very beginning. Could you give people some insight into how you exactly decided to invest and what you were looking at to make sure that the property manager was up to your standard as well as the market?
Yeah, that's a great question. I mean, because the bottom, like the most important part that I've found through this entire process is that it really comes down to having a good property manager. Nothing happens without good property management. It is, and I've gone through the gamut at this point. I mean, talking about like that first house that I bought in Houston, I've literally had the same tenant the entire time, but I've gone through 4 different property managers in Houston, which like,
Wow.
and it's not something you want to do. So, it's just because not everybody is the same. Not everybody gives you response time. So everybody's different. So, but you kind of have to kiss a lot of kiss a lot of frogs, I guess would be the right, I don't know if it's the right term or not, but you have to just go through it. The biggest shortcut to avoiding kissing a lot of frogs is going to where people have where you basically go through referrals. I mean, referrals and kind of and reputation are a big deal. So you have to have, it's kind of like going back to using other people's mistakes. People have a reputation, and really kind of just finding the right team that works with you is really important. So I can't emphasize that more, like that's literally the most important thing out of this entire process. So it's the housing literally is kind of the last piece.
So let's take that frog that you kissed in Houston, where the property management company is turned over 4 times. What's a lesson that you learned, maybe you put into play later on when you found other companies like JWB that you've enjoyed working with? What's something that you could teach others to do differently if you could change it again with that Houston property?
I mean, with the Houston property, one of the things is that I wish I would have done more, and it would have saved me more headache, is to literally fly and go meet them, like meet the team in person. If you can do that, I mean, that's not always feasible. I mean, I know, but it's especially if you're trying to buy a lot in different areas. But that's like the number one thing, that if you can do that, then absolutely do that. If you can't, then some of the things that you want to do is basically see if you can get like some kind of reporting from them, like if they have any idea of what their numbers are as far as turnover. And you want to look over the expenses, but I mean the expenses, the expenses is pretty secondary. It's like, it's really kind of how they position things and what it's like, you just kind of, it's like interviewing like anybody. It's like you have to just interview them. You have to talk with a property manager. And if you're not used to doing it, it takes a little bit of practice. I would say that having like a schedule of what you want to get done, like if you want, you should absolutely have your properties. And so if you don't have like an inspection schedule or something to that effect, then that's something that's really important to have. And if they can't provide, that was the biggest hang up in Houston, is I still don't have I've had a few inspections, but there's still work that needs to be done. There's nothing that it's a disaster still. So I'm looking at probably selling the house I've never sold anything, so that's going to be a whole nother process, but I'm literally selling it because of management. And it's like, and there's no other reason. Well, it doesn't matter. But so number 1, get inspections done. Number 2, interview everybody. Actually, and if you can just develop a relationship with them would be the ideal. And try to do phone calls as much as you can rather than just emails, because emails can get back. That's how I would do it. So just try to build a relationship with them and kind of see how.
I think it's sage advice. And I know there's a lot of folks that are in the chat right now, and I see the chat lighting up, that have purchased in multiple areas across the country. So if you guys have some ideas on things that you've done well to support others who might be thinking about doing the same thing, fire those in the chat. And for our friends on Facebook as well, this is meant to learn from the group. So really sage advice there for sure. For us, when it comes to property management, I guess we live in a bubble here where, communication for JWB is so critical. But what I find for outside property management companies, it's certainly not that way. When you talk to other property management companies, many times they don't feel like it's their responsibility to give you a phone call routinely. Many times they don't even feel like it's their responsibility to give you a phone call when something is going wrong. They expect you just to see it maybe in the reporting that they offer, or maybe they don't really offer reporting, or maybe it's not very in depth. So definitely make sure that the communication standards, are understood and they're up to your standard, because it's an industry that for many years was just mom and pops. It was just folks, and I say this sort of joking, but that accidentally got into becoming a property management company. Many times they were real estate agents that wanted some more of a consistent income stream, and they got into property management. That's not the same experience you're going to find if your standards are really high and you want to make this a big part of your overall financial portfolio. That's not, you want to have somebody who has a higher standard of communication. I think that's at the core edge is probably the biggest differentiator, I would imagine, through other property management companies. Would you?
Yeah, and just to kind of piggyback on what you're saying, I mean, one of the things that I've kind of developed is kind of like just a call schedule on my schedule to like go out and be in touch with the property manager. So just make it part of your routine, like part of like, like once a month, make sure that that you can look over the reporting. And if you don't understand the reporting, then call whoever the representative is over there that you have and kind of have them go through it with you. And you'll find out very quickly like how things like come to light, how some things don't come to light, and how the communication is, because you end up chasing the property manager, and that's not what you want. What you want is kind of a good relationship, but it's much more difficult than you would imagine it to be if you've never done it before. So it's something that seems obvious, but it just doesn't work out that way in real life.
Ed, I think when JWB put our standards in place for our communication, our customer service, we had Ed Cernobori in mind because, right, that type of a monthly phone call is so critical, right? It can be somewhat transactional in nature, but it can also turn very strategic, right? And again, if this is something that's going to be a big part of your portfolio, it's almost less of a property management phone call and more of an asset management type of a conversation that you need to be having with your quote unquote property manager.
Yeah. And Ed, I know that you have invested in a couple of different ways. I know that you've gone the turnkey route. I know that you've gone a couple of other routes, which we're going to get into in a second, but we have a question here in the Q&A from a listener from France. Name is Anonymous Attendé. And they ask, did you buy before having property management in place, or do you put, what do you get first, the property, or do you have the management in place before you get the property?
So I can tell you the wrong way to do it is to basically buy the property first and then get the property management. I've done that. So don't do that if you can help it. The best way to do it is to basically, after you've identified the area, is to, in an ideal perfect world, you would find the area after doing research, be comfortable with the location, and then finding the property management. And then you do that through interviewing different property management. And then after that, even if you're buying the house on your own and fixing it up on your own and then handing it over, and it doesn't have to be turnkey, that's kind of, those are like the three basic steps. So, but you can also, because the property manager will help, they can even help you find properties if they don't have them themselves, or like obviously through JWB, they literally have inventory that you can buy from them. So you can you'll have more options with somebody that's more, that has, somebody that's more seasoned and has that capability.